Hope you enjoyed your weekend. We're looking at the dollar index as our daily chart. And this is the ICT Mentorship weekend commentary and lecture. So this is the dollar index daily chart. And as you can see, we have repelled away from that volume and bounce turn fair value gap. Moves lower. And our eye is trained in right below here for our sell side liquidity pool. And the market has, as I mentioned the last time in midweek review, we were accumulating more shorts in here, in between these two reference points here, which was the old fair value gap. It accumulated in there. Displacement to the downside. We still have a little bit of a sell side imbalance, buy side inefficiency in here. We did have a fair value gap between this low and this high. It came up and filled that rather efficiently on Friday and traded lower as we would expect. Now, since we had this lower fair value gap filled in and it's already shown a willingness to want to move away, when I see things like that, it gives me the confidence to trust that it doesn't need to go up here before going to the liquidity. Now, if this fair value gap wasn't there and we didn't have it like that, it could be still in the realm of possibility of trading up into it at a later time. But because we had this imbalance filled in and it's already shown a willingness to trade below the low here, then that to me warrants a little bit of confidence that it's most likely going to go to this low here for the sell side before returning back up to here, if at all. This shaded area here is also a weekly buy side imbalance, sell side inefficiency. So that's another reason why I've been favoring this level here. So if you've been ignoring your weekly chart, put your dollar index on a weekly chart and you'll see this range rather clearly in the form of a buy side imbalance, sell side inefficiency. In other words, one big up green candle in between two candles that frame it out as a fair value gap. And below that we have a sell side liquidity pool here, which if we get really animated, it could drive down into. But before we get to that, we have this bullish order block. So if we trade below this low and we hit here, that might warrant a rebalance higher if there's like a sell side imbalance, buy side inefficiency between breaking this low and trading to this order block. So that might be something in there that sets the stage for a bullish up close day or days. And then if it wants to continue lower, it'll do so after that. But I'm just watching this level here as a means of potentially slowing down any decline on dollar. Not that it's going to cause a reversal. That's too early to tell that. It can, obviously, but I don't see it yet. So I have to see what price is doing as it hits that level and what time it hits that level. So that's all part of the forecasting element to analysis. We can have scenarios in our head as to what we would like to see, but we have to still wait for the candles to paint to make a decision on how we're going to frame risk. All right, dollar index is our hourly chart. And this is that bearish order block on the daily chart. And we have that fair value gap here. Traded up into that, broke lower, came back up into the bearish order block, traded lower, bearish order block again, trades up into it, and then trades lower. We do have sell side liquidity pool resting below these relative equal lows. Then the sell side liquidity here relative to that old daily low, as I mentioned, and this is the beginning or premium high of that weekly buy side imbalance, sell side inefficiency. So overall, I think that we're going to continue. That's what I'm expecting. We opened up the week on last weekend's commentary. I stated that I would favor a weaker dollar, higher foreign currency. I reiterated that on midweek review on April 14th, 2021. I stated that I'm still favoring the lower dollar, higher euro, higher cable. And I'm sticking with that until we get down to here. And how we trade at this level and what time and how it's done in terms of delivering price there will help me to determine whether or not I'm going to remain bearish at that point or expect a deeper retracement back up into the imbalance here as mentioned on the daily chart. All right, here's the euro dollar daily chart, and I said we would be drawing up into these relative equal highs. We did that on Thursday and on Friday. Not as much as I would like to see, but it still could potentially trade higher. We have the remaining balance of the sell side imbalance, buy side inefficiency between this candle's low this candle's high. So that's that shaded area here. Okay, so I didn't want to put more lines on than it's necessary so that we can keep things clear. If we need to retrace lower, I'm watching this order block here. That should cap any downside. In other words, if we keep these highs intact and we start off on Sunday money trading lower, I'll be looking for this level here as a potential reversal point that would then send us up into this level here. But I'd rather see it not do that. I like to see the dollar stay heavy. That means remain bearish and unwilling to make any serious rallies intraday and up closes on the daily chart. All right, here's the euro dollar hourly chart. And we do have that sell side liquidity pool resting below these lows. Market consolidated in here and then finally expanded up. This is that order block on the daily chart. So if we do trade down for a retracement, that's the low I'd be watching. And we have relative equal high. So I'm looking for this to want to continue up on Sunday into Monday. And we'll see if we get that. I'm favoring that on a continuation, higher foreign currency, lower dollar. All right, British pound daily chart. Now, if you recall on Wednesday, I said that at that time on Wednesday, I wasn't sure if it was going to go higher or lower because we had a sell side liquidity pool and a buy side liquidity pool, and it could go either way. And I wasn't sure, to be honest with you, what it wanted to do first. But I did give you a very specific level that I thought was favorable. Now, while I didn't give you a very clear, this is what's going to happen with cable on Wednesday into Thursday, because I said I didn't know, I was waiting for more information. We had a buy side liquidity pool and a sell side liquidity pool that could have gone either way, and you have to wait for more information. And what information was I waiting for? Now, obviously, the best scenario is to buy when the market goes into a deep discount and attack a premium level. That means I wanted to see price go lower to pick up more orders and then go higher. What was I reaching for? What was my ideal scenario for an upside objective? I actually gave you that in the video on Wednesday, and I'll make a mention of that in a couple moments. But it's important to remember that sometimes when we're doing these midweek reviews and or weekend commentaries, the markets aren't going to be perfectly lined up with when I'm going to speak to you. So there's going to be times where I just don't know. But I'm going to give you what information I have and what information I'm utilizing for the weekly range. So what I'm looking for, what draws on liquidity I'm looking for, what things I don't want to see, what things I favor seeing than not seeing it at all. So that's really the core of mentorship. That's the experience factor that I'm lending to you as a student of mine. If you look at what we have here, we have the daily chart for British pound, and we have this last up close candle. And originally I had the opening price and the low extended out in two lines. And ultimately I'm just going to use the opening price here, which is the daily bearish order block, and we're using the opening price. And down here we have the last down close candle, which is the ICT daily bullish order block. And I'm only framing it on the opening price, extending it out in time. With these two reference points here and this old high right there, those are two reference points on the premium side that are going to be most salient. And if you drop down into hourly chart now, here's the hourly, and you can see how the market traded on Monday. And remember, we started the week on Sunday with commentary that was bullish cable, bullish euro, bearish dollar index. So the week starts right on Monday, trading at the low. It rallies, comes back down in, optimal trade entry, trades back into a imbalance. So buy side imbalance, sell side efficiency is effectively rebalanced here with optimal trade entry. Then it rallies up through relative equal highs, trades to this level here. And on the 14th, we kind of like tread water. And I wasn't sure what it was going to do. And I mentioned that I would have liked to see it go down in and close in some imbalance, but not entirely, and then trade higher. So the bias was still bullish, again, with the weaker dollar in mind and higher euro. That kind of like gives a slant to cable. While I didn't have the actual setup I was looking for, and you can see that we did continue into the 15th, where it was still questionable as what it was going to do. It was just really mixed. It wasn't offering a whole lot of opportunity one way or the other. Then finally we had a displacement. What did it do? It dove deep below the relative equal lows here for sell side liquidity and dug into that daily bullish order block. Okay, remember I showed you on the daily chart before we dropped down to this time frame. This is that last down close candle, and I was using this level transposed to the hourly chart. Also, we have the rejection block, which is the lowest down close candle price here. Extend it out in time. Look at the beautiful symmetry with that. Last down close candle. That's the overlap right there with that closing price on this candle. Very, very nice. Yes, we have that little bit of a tail, but that's not that big of a deal, is it? The bulk of the volume is in the candlestick's body. We have that here. And the market accumulates and rallies. Attacks the buy side liquidity here. And ultimately trades up to this little area right in here. What is that? That's our buy side liquidity pool and the remaining balance of this fair value gap. Now, if you're not paying attention in the weekly commentaries and making notations as to when I'm saying certain things, you'll miss what I mentioned at the 54-minute mark on your video, April 14, 2021. I said that this is the area I'd like to see it trade up to. I favor that. I think this is a good area where it's going to draw up into when the market was on the 14th here. Now, when you see that and go back and listen to the video, you'll be like, oh yeah, it's right there. But when it drops down to the deep discount and it starts to rally, that's when you're really going to focus in on this level here. But while it's in this consolidation, it's just a likelihood, not that it's going to absolutely do it. So when we're looking for weekly highs and weekly lows, just like daily highs and lows, they are high probability levels of liquidity. That's what I'm trying to teach you. That's what I'm trying to give you examples of each time we spend midweeks and weekend commentaries together. And even though it's daily log entries, I'm trying to train your eye and by repetition to see these types of things. So if we were looking at price just right in here before this high was even formed, in other words, from this down close candle to the right, pretend that wasn't even on the chart, and this was the only candle that was the furthest on the right hand side, this up close candle here. If you were asked by me, where are the relative equal highs or clean highs, your eye should readily jump to this level here and up here. That's exactly what I was talking about on the midweek review. Now, again, I'm not trying to pat myself on the back and act like I'm smart. I'm just saying that I gave you this level here, and I readily admitted on Wednesday I didn't have a clear setup because there wasn't enough to work with. But when we see the market drop down into a deep discount, into a discount array like a daily bullish order block and a rejection block, and it starts to move higher, then you can reasonably expect to see things like this pan out. The market rallies up. We have a redelivered rebalance, which is this up close candle's high. The next candle we trade up and then come back. The next candle we trade up through it. And the next candle we trade up and come back. And that low and this high frames the redelivered rebalance. So this candle here and this candle here, we take those completely out of the equation and we go right to this low and this high, and the market trades down into it, and we treat it just like institutional order flow entry drill. The market rallies from there and goes higher. Now this is going to be important when I teach you the lesson in this weekend commentary, which is going to be focusing on micro market structure and the significance of 10 pip ranges. And here is the ultimate delivery of price. Again, that buy side liquidity pool, the fair value gap, and then we punched up into that right before the closing on Friday. And it was offered as the weekly high. I know, it's pretty random. All right, so let's talk a little bit about our lecture points for this weekend. Now, obviously, the British pound, we were looking for higher prices on this pair, just like we were looking for higher prices on euro. Now, when we're looking at the weekly range or studying how the weekly range may form, the 4 hour is crucial for doing that. It helps us give us a higher time frame without going to the daily, and it gives us very key reference points for institutional order flow. It gives us key turning points. It gives us the framework at which the weekly range should fulfill. And what do I mean by that? Well, here's Monday's trading. It creates the low here. Now, it very well could have easily traded below these lows here, but it didn't. That's fine and great. I don't care. And that's why the bulk of trading that I do doesn't occur on Mondays. I'm allowing Monday to trade to give me more insight. Now, I might miss, like an instance like this, I might miss the very best buying opportunity near the low of the week, and that's okay. I don't care. The very next day, we have the market eventually working its way lower, trading down into this low, which is exactly the midpoint of this candle here, which is mean threshold. Down close candle prior to a run up. When the market is bullish, that is a bullish order block. High probability order block, when it trades to mean threshold, you have a likelihood of a turning point there. Now, when you watch this candle come down live, it looks scary. It's a little intimidating because it's full on, bold, blunt-ended, down close candle. Then it reverses and goes higher here. Ultimately, it trades higher, creates this high, and then this high here, which is a buy-side liquidity pool. But look what's occurring here. We have a sell-side liquidity pool as well. So in this scenario, if we're looking at just this shaded area, where would there be the highest probability for catching along to this level up here? Would it be buying the breakout above that? It could happen. But I teach you how to trade with an institutional mindset where you require movement lower to buy into. You don't want to be buying in up movement. That's only done as a protective buy stop being engaged. That's the only time your order should be transferred to the marketplace as market orders. When the market's going up and you're buying, that's a stop loss being triggered. That's always something that's permissible, okay? But if you're buying, it needs to be done as a down movement. You want to be trading against the intended direction of your trade. In other words, if you're going to profit if the market goes higher, you enter as the market goes lower. That's institutional mindset. That's how you do all of your entries, and that's the best way to frame all your trades. If you do that, you're going to give yourself such an advantage, and you're going to find many times that your dealing spread is going to be covered rather efficiently and quickly versus trying to buy something that's already on the move on the upside. And everything I just said there, reverse it for going short. But the ideal scenario would be to see the market trade lower and go into the sell side liquidity first. Why? Because those sell side liquidity pool orders are resting sell orders. They want to sell at the market. And if you dive deep in there like that and into the daily bullish order block, it's really allowing the market to accumulate new long positions with a very rich pool of liquidity of willing sellers at a lower price. Because as the market was up here, it went down on this candle. So for 4 hours, we worked the range from this candle's high and this candle's low, but it was attacking all of this here. And it was perfect as a counterparty for buying here and offloading it here before the close of the week. So buying down here and targeting right up there, as I was indicating on the 54-minute mark of Wednesday's video. Not support and resistance, not supply and demand, not Elliott wave, none of that stuff, okay? Nothing harmonic about it. But all of this in here is accumulation, and then picks up the orders for offset distribution where there's willing buyers. Why is there willing buyers up here? Because they're short, and this is the last swing high, and interbank traders know that there's going to be liquidity there, and if they wait for the algorithm to reprice to that level, that gives them the opportunity to offset distribute their long positions from here, and you're pairing up their sell stops that are resting here with their willing participation of buying, because the underlying narrative is it's only going lower to go up to here, and those sellers are their counterparty to be a buyer, and then they wait for the algorithm to take price up to this level here where they can be a seller to these willing buyers at a higher price when price was down here. All right, and now we're going to take it down into a 5-minute chart. Now I know a lot of you aren't really interested in 5-minute charts, but you should be interested in how the market delivers. Okay, the price of any asset is really the heartbeat of your trading. And it doesn't make a difference what asset class you trade, but if you look at Forex, this is one of those markets that have really specific characteristics that I'm going to show you a little bit of today. Now, in the last week or so, since the break on Passover, I've been doing a lot of high frequency trading, and I've got a lot of questions about high frequency trading and what is high frequency trading and why am I even talking about it in my Telegram channel and why am I teaching that there and not teaching it here. I'm not teaching it there, folks. Okay, I'm just demonstrating it just to show that there is a strong contrast to what people think they know about me and what I'm able to do and what I'm actually capable of doing and proving. So it's more or less me standing out there saying, you all say I can't trade, but here I am doing it. And these are the results. Can you replicate it? And you can see nobody's doing it. Now, it could look like I'm standing out there beating my chest, but I'm only out there setting the precedent before I teach the free level stuff, because so many people come into that channel saying that I blew an account here, or I can't trade, or this, that, and other thing. And to do away with all that right from the jump, I did what I did, and now I'm going to be teaching basically amplified versions of what's shown already on my YouTube channel. Okay, that's the I guess the alternative to being in mentorship without teaching mentorship. So high frequency trading is a form of trading that algorithms operate in. Now, when I say an algorithm, it doesn't necessarily mean my personal algorithm. What I'm saying is there are institutions that have high frequency trading algorithms, and for the most part, what I'm going to show you today, most of them rely on what I'm going to kind of like highlight. When I was in computer science and programming and really heavy in all of that, and I was programming my own algorithms with TradeStation and things of that nature, Metastock and stuff. Those are applications or platforms that were used back in the 90s, and you could create your own trading plan model and integrate it to what price is doing and then automate it. And I had a lot of those types of things back then, and please don't ask me for them because I'm not going to share them with you, and I never promised that, so don't get upset either. But when I was building all of my early stage price action models, the things that I studied most was the idea of how high frequency traders were working inside the marketplace. See, I have a unique experience because I came up during the transition from open outcry pit trading to electronic trading. Whereas everyone today, 20, 30 years old, they predominantly have just the electronic trading experience only. And they don't have the waiting for your broker to pick up the phone and wait for your order to, it's a lot of stuff. The whole time the market's trading. And it could be rather scary, and it was for me, and caused ulcers and all kinds of stuff in my stomach to be part of that type of trading. But I'm thankful that everything has moved to electronic because it makes things much more efficient. And to answer an reoccurring question that comes to me a lot is, by me teaching this, is it going to weaken or make it obsolete? No, because it doesn't make a difference what I'm teaching. The markets are going to do this because this is how the markets have to deliver. Okay, it has to happen this way for them. Okay, it works this way for them. It's efficient, and think about how hard it is for you. You know enough. You know enough about a fair value gap. You know enough about an order block. You know enough about daily bias. I'm even giving you the daily bias. I'm giving you the weekly bias. And are all of you making 500% a month? Are you making 100% a month? How about 25% a month? You see where I'm going with this? I'm not trying to belittle anyone. I'm not trying to talk down to anyone. But you know these things, and yet still you are not really seeing exponential growth. Why is that? Is it because the concepts don't work? Or is it because your infancy as a trader and you haven't conquered yourself yet, mastering yourself, controlling your impulses? Some of you that just came in a recent group did not listen and started with trading with funds that you should not have been trading with, specifically live money funds. You can't do that while you're learning. That's like trying to learn how to drive while you're drunk. Okay? It's not favorable, and the outcome's probably not going to be what you want. It's going to be the adverse side of things, not the best case scenario. So when you consider the things I'm teaching and how, yes, they're being tossed around on YouTube by people that have no idea what they're doing with it, and they're diluting the initial perception of it, so it turns people off. When they can't get anything off of it right away, they'll just abandon it. And they can use all my buzzwords, smart money concepts, institutional order flow, all of that, breakers, order blocks, all those things. Okay, they can talk like me and get people to listen to them and watch their videos, but they can't trade, and their students watching the video will never be able to trade with it. So go back to that initial question. Will this change because I have taught it? No. Because not all of you are going to be successful. And that probably sounds troubling to you. But I'm a realist. I've already had people quit. I've had over 166 people leave from the first group. They did not continue to this month. Now, I'm sure some of it has to do with frustration from not being spoon-fed a signal. Others probably got frustrated with the transition from one server to the next, or they just figured out that this is going to require much more work than they're willing to put into it. Later on, as you get deeper into the content, you might hit another wall for yourself, and you might think, yeah, this is a little too much for me. And you'll probably feel that in month 5. It's a lot. Then you might decide to quit, and that's completely up to you. Now, you are all part of this original 2021 beginning of the content, me teaching, the commentaries, the analysis, all that. You've watched so many things still pan out to script, and yet still not all of you are able to take that and make money with it. And it does not diminish what I know, what I teach, or the effectiveness or the valuable aspects of what you're learning here. It just means that you can't do it personally yet. And that's why I'm telling you that there's no reason for you to worry about me teaching this, because it can be tossed around out there, but it's going to fall on deaf ears. It's going to land in the hands of fools. They're going to blow their account. And anybody that listens to people that think they know how to do it, they're going to blow their account. And then when something else comes up and it sounds cool, someone else does something with a trading contest or whatever, and they say, this is how I did it, they'll all scramble to that. It's always like that. I have hid in plain sight for almost 3 decades. I've had 100 or so people that I work with, on a personal level before I stepped out on baby pips. I've done consultations. I've had brokers reach out to me. I've had institutions reach out to me. I've had all kinds of corporations reach out to me over the years, and I've shared insights with them. And even with all of that, it still has not diminished any of it. So there's no reason to worry about it. But I get questioned a lot now because of my mentioning of high frequency trading. And what is high frequency trading? High frequency trading is when an algorithm sends orders to the marketplace, and you couldn't really do this prior to electronic trading. Like, you couldn't do this type of trading when it was call up your broker, put your order. That just wasn't there. Okay. When everything went to electronic trading, I knew when it started that would be the most efficient way of doing rapid fire entries and exits. And that's exactly what I was daydreaming of when I used to drive a truck filling up vending machines, candy machines, and coffee machines, and soda machines. That was my job when I was learning how to trade. So while I was driving around daydreaming about how I was going to eventually retire at 40, I thought to myself, if this could ever become a market that was electronic, where we didn't have to call a broker and just click a button on our screen on the computer, that would be crazy, because I could set up an algorithm that would literally go into the marketplace and place my order every time it did a certain type of thing. And being who I am and meeting the people I met, it also allowed me to meet other institutional minded individuals that left the institutions and went home and started trading their own private funds and or hedge fund. And some of them were quants and some of them were high frequency traders. And some of the ideas I got about how you pipe in these orders into the marketplace, I got from working with these individuals. Now, they didn't teach me the things that I teach you, like fair value gaps and things like that. They just taught me principles of aggressive multiple orders being entered in the marketplace. And they would be adding in as the market was going up. They're buying. Every time the market would break to a new high, they're buying. And that to me always went against the underlying premise to accumulation and distribution. Now, I did a video on YouTube where I talked about the difference between IPTA and Wyckoff and why my approach to analysis is superior to that and everything else, and why it's not Wyckoff. Everybody likes to think it is and say it is. There's a goober on YouTube that actually made a video saying that this is what ICT doesn't want you to know about Wyckoff. And he takes a little piece of my video and says, and quotes basically me by playing a little snippet of what I'm saying in my own words. I say, the beginning building blocks of what I do stems from the ideas I got from Wyckoff. Now, that was kind of like closely paraphrasing what I said, but it was completely taken out of context, because when I watched the guy Dennis, who I used to troll on America Online back when I was trying to learn how to trade, and I was frustrated with myself because I couldn't get it to work. After my initial luck of 9 months winning, I couldn't make another penny after that because the market was going down, and I couldn't figure out how to short, and it didn't make sense to me. So I was an infant in my trading, and I didn't know what I was doing. But my ego at the time, because I made a lot of money real fast on ignorance, but I attributed it to skill, I saw a gentleman talking about Wyckoff on America Online. And back then, everything was a message board. So it was like kind of like a forum type setting, and it was really archaic, but it was a way for us to communicate and update each other what we were doing and read other people's thoughts and things like that. Well, this guy Dennis was teaching Wyckoff, and as soon as I saw the descriptions of what he was talking about, like crack the ice, jump the creek, and all that stuff, it was just like, what is this nonsense? It didn't sound technical to me. It didn't ring off, like stochastics and MACD and bullish divergence and hidden divergence from Nick Van Ice. Like, it didn't feel like that was trader lingo. Okay. And without getting into all of the, ignorance that I did, because I was really stupid, much like the trolls I have today, but I understand them. Y'all wonder why I sport with them. It's because I used to be just like that. As much as it probably is hard for you newer students to think that I was just like these trolls, I was absolutely a troll. And what I was doing was I was venting my own frustration against other people. And I was just looking for someone to bully. That's really what it was. Because I was not successful anymore after that first 9 months because I didn't know how to trade. So we're talking about 1992. Okay. So in the year of 1992, my first introduction to Wyckoff was this guy Dennis on America Online. And he was nobody. He was just like me, just putting up things on the internet. And he was trying to communicate and teach Wyckoff. Now, I guess it would have been better for him to just say, hey, here's the book I learned from, but everybody wants to be something insignificant, and he was trying to teach it. And I would go onto his message board and I would troll him. And back then you couldn't block anybody, you couldn't, delete anybody or do the things that people can do with social media today. So you were kind of stuck with me or anybody else that would do things like that. So And I had a couple trolls back then, but they didn't last very long, because when I finally learned how to trade, it was like everybody was following winning trades all the time, and it was really cool. But anyway, back to this guy, Dennis. When I was looking at the things he was referring to, I went down to Trader's Library in Columbia, Maryland, and I bought up all the books about Wyckoff. And the only thing I got out of Wyckoff was the initial understanding of a concept of accumulation and distribution. Now, it's really important that you understand the difference between me saying I have been introduced to a concept that prior to 1992, I never really understood accumulation and distribution. Because I thought, like anybody else at street level, like for instance, if you talk to someone about stock trading, the common understanding is you buy a stock low, and if it goes up, you sell it. Okay, great. You buy it cheap and you sell it when it goes up. That's the extent of it. But now change that to a narrative like the stock goes down to a level where smart money can go in and accumulate it when it's cheap, and then they sell it when it becomes expensive. That's what I meant when I said the first building blocks to my understanding with the concepts that I trade today came from Wyckoff. There is absolutely nothing, okay, in what I'm teaching that is anything like Wyckoff. Nothing. And I'm not here to repeat myself like I did everything in that video on YouTube. And you're welcome to go and look at that. It's, IPTA versus Wyckoff and something to that effect in my YouTube channel. But someone shared a link to me in email, I think it was on Wednesday, and I watched it and I was like, what is this? What is that? I mean, they all want to sound smart. A lot of the Africans, they're really buzzing right now with Wyckoff, okay? And they like it because it's a way to mask my content and say it's Wyckoff, because Wyckoff's not going to come out of the grave and say, look, you SOB, stop doing this with my content, or to that effect. Where I will say, hey, look, stop trying to be me. But the Yahoo basically was trying to say that here I am saying in the very video IPTA versus Wyckoff, and where I'm ripping Wyckoff apart. And I guess he's trying to say, I gotcha. You said it right here in your own words, where that's completely out of context. And I later on in 1995 grew to understand a little bit more about this idea of accumulation and distribution when I was introduced to Larry Williams' accumulation distribution formula. And then it started clicking more because I could see visually, which made much more sense than all these jump the creek and crack the ice and all these types of schematics that Wyckoff had. It's a way to describe the past. Wyckoff is really good at that, okay? But I don't use any of those things to forecast the future, and you can clearly see it in my delivery of the content. There's nothing in those schematics that line up with what I teach. My market maker sell model, my market maker buy model is nothing like any Wyckoff schematic. And this gentleman that's on YouTube that tried to make a name for himself and try to say this is what I'm trying to hide about Wyckoff, I basically leveled the whole idea of Wyckoff. And you can clearly see, if you study them side by side, there's nothing relate to any one of those things lining up. It just doesn't happen. But what Wyckoff introduced to me was this idea or notion of an accumulation and a distribution. What is accumulated and what is distributed? What is it? It's positions, and how you take from the have-nots and you accumulate from that. You're buying sell stops, you're selling to buy stops. Now, Wyckoff doesn't necessarily come out and say those types of things, but it gave me the idea of understanding accumulation and distribution. I immediately discounted all the mumbo jumbo schematics because, again, that stuff is just a way of explaining, like the news does the day later. How are you going to benefit from that? That's why they only tell you the lottery numbers from yesterday. They don't tell you the winning lotteries tomorrow number. They don't tell you those. They tell you what already happened. They're like newspapers. They tell you yesterday's news, labeling it, and everything's hindsight in 2020. And it's the same excuse I always say about that type of style of trading And more or less the discipline of trading of Wyckoff is it does a brilliant job of explaining everything after it's happened. But just like newspapers, they're never going to tell you the winning lottery number for tomorrow, but they'll always tell you what the winning lottery numbers were yesterday. My stuff points to what the next winning lottery number is going to be. And it's always the type of delivery that we're looking for. You don't know if you're jumping the creek or breaking through ice. You don't know what schematic you're going to be using. None of that stuff, okay? And I spent a lot of time trying to make that stuff work for myself, just like I've tried to do it with harmonic, and just like I've done with Elliott Wave. I've done it with everything, okay? I've done everything, point and figure charts. I've done all of it, folks. And it's crap. But when you understand that that concept of accumulation distribution doesn't, in effect, exist in price, it can be applied in micro market structure. And what do I mean by that? Well, we're looking at a delivery of price between an area of accumulation inside the daily bullish order block down into the rejection block. It rallies away. Look at this area of price action from here to where we were looking for relative to that 54-minute mark in Wednesday's video. That's this level up here, okay? How many trades do you see? Okay, I want you to pause the video. I know a lot of you don't do this, okay, but I really want you to think about pausing the video here and tell me how many trades you see. Now, I'm not going to do every single one of them, okay, but I'm going to pull out trades that you probably didn't see, but you're going to look at, obviously, the clear ones, but I want you to see how many trades there are. And some of the things I like to do in my pastime is during the New York session, I'll go on YouTube, and there's a few channels that do live sessions, and they talk about what they think is going to happen in the marketplace. And it's really fun for me to sit back, in anonymity and smile to myself because they're saying, okay, I'm waiting for a trade. Okay, I'm waiting for a trade. I'm waiting for a setup. And the whole time I'm looking at trades form, I'm like, okay, this is a buy. Okay, this is a buy right here too. And this is a buy right here too. And they're waiting, and then they don't take anything. Now, obviously, it sounds arrogant of me, but it's a way for me to think about how I used to look at the marketplace too versus how I can see the market now. And what I'm going to show you here is, if you haven't already paused the video, pause it now and try to figure out where there's multiple entry points, okay? And then I'm going to go through it and step by step and show you where they are and why they are. Still, some of you just don't pause it. All right, so the first one in here is going to be obviously framed on a 10 pip delivery cycle. So I have every 10 pips in here from this low forming up to the high where we're anticipating price. Now I want you to imagine for a moment a high frequency trading algorithm, how they would go in and trade. Now I'm going to show you what the majority of them do. Okay, and if you catch the right side of the marketplace, it can be wildly profitable for them to pyramid positions and build it up. A lot of them do 1 1 1 1 1 1 1. Some of them start with a big position and go lower and go lower and go lower in size each time they go in. Others, and these are the ones that usually crash and burn, they start with a small position, they build bigger as they go. And that to me is foolish, but there's a lot of gamblers out there. They want to get rich real quick and try to make 1 year of trading a whole lifetime worth of income, and that usually doesn't work real well. But if you look at how every 10 pip line here, there's a storyline that's occurring, and you may not necessarily see it right offhand, but I'm trying to explain a little bit to you. But first, just know that every time price takes out a swing high and it trades through it, a high frequency trading algorithm would take that as a buy. So in other words, this swing high here, they would be buying here on a stop. If it takes a run above this high here, they're buying it there on a stop. When this high is taken out here, they're buying it on a stop. When this high here is taken out, they're buying it on a stop. When this high here is taken out here, they're buying it on a stop. When this high here is taken out, they're buying it on a stop. When this high here is taken out, they're buying it on a stop. That means as soon as it trades there and goes above it, they're triggered in a new long position. Now right away, that's a lot of positions. a lot of entries, a lot of setups, a lot of signals. I don't like to trade that way. Okay. One of the things I like to do is use the things I've already taught you. And the first one is this right here. You know what this is. It's a fair value gap inside of a bullish order block. Now I'm buying when it trades down into the order block at a discount relative to this high, this low. We're below midpoint or equilibrium, and we're at a discount, and we're at a PDA rate. It makes sense to go higher. I would be buying right here. Now, what I'm looking for is how price is going to run to the next level, 10 pips higher. Whereas prior to this run in here, we went up, down, rallied through this high, and now as it retraces, I'm going to catch that entry here. Now what I need to see is I need to see the previous high, which is this high here. I need to see that broken. Just like the high frequency trading algorithms, they get long here. I'm waiting for this imbalance to fill in, and then it retraces lower. I'm buying there. Once I buy that, I need to wait for this high to be broken through. It does. It trades to the next 10 level. Once that occurs, I can take this next trade if it trades to another 10 pips higher. So I'm working inside of 10 pip delivery cycles. The market trades back down into another fair value gap right here. I can buy again. The anticipation is we're going to trade through this threshold of 10 pips and go to the next 10 pip marker here. Then once it trades there, I can trade another discount array, which is right in here, another fair value gap, trades down into institutional order flow. I could be a buyer there. What am I waiting for? I want to see it trade up to the next 10 pip level. There, it does. And it trades lower, trades into this level here, which is what? Redelivered rebalance. This level here, redelivered rebalance. So in other words, we have all these candles back and forth on that 15-minute time frame. So that cancels out all of this area in here until we get trading down into this level. Now we're at a deep discount, and this candle is what? A bullish order block. So now we're at a deep discount. We've taken out a swing low, which we haven't done that any time in here. So we have our first stop run. Swing low, short-term stops, tagged, back to the order block. So now I can be a buyer here. The algorithms that trade on a high frequency basis, they're going to buy above this swing high. I'm entering down here. The market rallies back up, trades above the high. For high frequency trading algorithms, they're going long there. I'm already long down here. Price trades up to the next 10 pip delivery cycle, and then it drops back down into what? Redelivered rebalance on that 15-minute time frame. This is your next buying opportunity. Then after that, the market rallies, goes to one cycle of 10 pips higher, but does it break the previous high yet? No. Does it trade up to this one here? No. But is it dropping down into a level where it would be likely to deliver a low risk entry? We have a fair value gap here, and this is probably going to be the last opportunity for me because look where we're at trade wise in time. We're in that hour where profit taking is, but has it traded to our level up here on that 15-minute time frame, an hourly chart? No. So this right here is a trade I would take, and it gives you two opportunities to do so. Buy, and then finally it runs. You can't take any more trades after 11 o'clock because that closes your 8:30 to 11 o'clock New York session, trading window. That's not our New York kill zone, which is 7 to 10, because you understand what that is. But we have the 10 o'clock to noon profit taking London close time period. So we don't really want to initiate any new long positions because generally that's the time when the market starts squaring and they don't want to hold those positions, or maybe you'll get retracements. But it's Friday, so they're likely to take it up into our objective for the weekly range. So this is your last high probability entry, and you have to hold on to whatever you got, all these positions in here. So you have 1, 2, 3, 4, 5, 6, 7 trades. 7 trades during the New York session. Well, not all of them, but you have these 2 here. And then why is this a deep retracement? I failed to mention this earlier, I apologize, but this deep retracement is occurring where everything else is just a steady run up like this, real tight and delivered. This occurs because what are we crossing into? 7 o'clock. That is the New York open kill zone. There's always a Judas swing that occurs that's dropping down when we're bullish, and then you can wait for it to trade with a discount array here. So when I'm working with 10 pip ranges, and I can run up accounts and build it all up with 10 pip ranges, I can do a lot of that with what I'm showing you here. This is not Enigma, but it's just me using everything I teach you on a very small time frame using 10 pips. 10 pips is enough. Any one of these trades, if you would have positioned yourself and held on to it till it got up to that level we were talking about at the 54-minute mark of Wednesday's video, you all should be excited about that. It should be viewed as, wow, this is, this works. But it's a matter of taking everything I learned from other approaches and canceling it out and looking at it from an opposite perspective. Now, back to Wyckoff. I did not learn Wyckoff theory and trade like you see me now trading. I don't teach Wyckoff hidden with new buzzwords. That's not what's going on either. I don't teach what high frequency quants do in their approach to high frequency trading. I just taught you and showed you what they do, and I just showed you what I do in contrast. If you look at both of them, they're both profitable. But which of those two schools of thought would you rather subscribe to? Would you be buying a breakout? Because I also teach sometimes that's not always good. And what if you're wrong? You're going to be buying at the worst opportune time. Whereas if I'm wrong, I'm buying it down here. And if this was a false breakout, I'm buying it down here and I'm closer to where my stop's going to be. Versus buying it up here and my stop's down here. So let's run some scenarios here. Say that you are trading British pound and you have the funds and the experience and the wherewithal to go in with, say, 20 lots. Okay? So you go in and you buy your first one at 20 here. The next one, you go in here and you buy 16. And the next one here, you buy 12. The next one here, you buy 8. The next one here, you buy 4. The next one here, you buy 2. And the next one, you buy 1. That's one approach of how I could go in and how you could go in too. Scaling in with your largest position, managing risk as you go, and every position is significantly smaller. That way, if you do have a reversal and comes back, it doesn't have a drastic result of drawdown. It doesn't completely wipe you out. Yeah, you could lose money, but it's not as big as you might think. Versus if you went in and bought 1, 2, 4, 8, 16, 32, and 64. Any retracements in something like that is going to be significant, not to mention very stressful. That's what I was doing in commodities in my first year. And while it was great when I was right, when I was wrong, I wanted to crawl under a rock. It was bad. It was really bad. And sometimes in certain trades, I had just luck on my side because it could have easily wiped me out. When I had a lot of money in the account, it could have easily wiped me out in that one trade. And when I mean wipe me out, like wipe me out and owing broker money. Okay, that's the way it worked back then, where you have the protection of, okay, I'm going to trade on full margin, no stop loss, and if it kicks me out because of margin, at least I won't be broke. You have the ability to do that today. We didn't. If you went past, your stop because the market traded through that, you eat it. That's the way it was. There was no, you went below margin. That occurs, but they have to see that you went below margin. Then they have to pull up your account. The whole time the market's still trading. Then they go in and they close your account, usually a much later time than you want it to be done. So what I'm showing you here, in case you've missed it, is that the market tends to work from one level to 10 pips higher or lower, but when we have institutional order flow in our favor, in other words, we're bullish, what I'm looking for is a run above a swing high, and hopefully it makes a run of 10 pips. Because The algorithm that delivers price likes to see 10 pip delivery cycles. Now, that is not to mean that it's always going to be step 10 pips, come back, retrace, 10 pips, step, retrace, and run 10 pips more. That's not what I'm not saying that or suggesting it in any way, shape, or form. But I'm always studying price in the scope of 10 pips like this, because it offers me a greater understanding of order flow, and it also gives me opportunity to get in trades that would otherwise be missed by the average person. Even a skilled trader that's been trading for a while would not see these entry points. It doesn't register to them. And if you start looking at your lower time frames and stripping the market down like this, you'll start seeing things that have been evading you all this time. You'll also start to see maybe the infancy of your model becoming flesh. You'll be able to see things that, wow, I like that setup. This one makes sense to me. And you'll also start seeing where you're looking at things incorrectly. And that was painful for me when I was coming up, because I started seeing things where it showed my weaknesses. And I didn't want to see that. So I put off back testing, because it made me realize that the things I treasured with stochastics and continuation patterns, classic retail theology, I was wanting that to work for me, because I invested so much time. I did not want to abandon it. I didn't want to feel like, well, I'm throwing it out, throwing the baby out with the bathwater. I put time into this. I want it to work. I don't want to fail. Well, at some point you got to realize that sometimes you'll have to realize that some opportunities are cleverly disguised impossibilities. Now, I don't like to say things that would be discouraging, or say you shouldn't do this or you shouldn't do that, because I know most of you have a lot of respect for the things I'm saying, but I want you to respect this and hear me. Retail theology is going to doom you if you stay with it, because it warps your perception and you will always look at things upside down. It's designed that way. All of the things that cause the markets to reprice how they do, it goes against 80% of that stuff. Now, why not 100%? Because some of those things are going to line up, because they have to keep people wanting to come in to the game. And that stuff, okay, is what we like to capitalize on. And I don't have any remorse for those traders that fall victim to that. They knew the risks when they signed up. They understand the risk disclosures. They signed an agreement stating they understand that they can lose their money. It doesn't make a difference if they lose it all or a little bit. They understood, just like you did and just like I did. Every time I opened up a live account, I understood. It was not without understanding on my part that I have the possibility of losing all of my money. I knew that. Each time, I knew that, just like you do, and knew, and maybe you suffered a blowout of accounts. And maybe you learned something from it, maybe you didn't. Having empathy for other people in trading, I have that for my students, but I don't have that for anyone else. I have a predator mindset. So all of you are part of my brood, okay? You're my pack. And I try to be alpha and give you what you need to eat, give you what you need to hunt, and also tell you this is beyond your threshold. Don't do this. You stay within your lane. And if you do that, you'll be in a good standing with the pack, and that means you will be able to be around to eat again. Some of you want to run independent, and you want to be lone wolves, and you aren't ready. And then the prey that you're trying to chase eludes you. And then you come back to me and you say, why is this happening? And I tell you things like I've told you in this video multiple times throughout the year, and you don't want to listen to these types of messages. So you have to submit. You have to submit to this stuff, because if you don't, you won't learn. But if you hold fast to things that haven't been proven effective consistently, then you're going to fail. But if I show you the things that make these markets price where they go, where they deliver to, why they do it, where the opportunities lie within it, it should be listened to. It should be written down. The notes should be taken. And I'm showing you and telling you how I got this stuff. Where did I get my entry strategies? I did it in the opposite of what I see everybody else doing. Remember when I first started talking about things on Baby Pips in 2010? I said, everything you've learned, turn it upside down. Everything. Turn it upside down and you will see it as it really is. And still, people want to still do harmonic. They still want to do Elliott wave. They still want to do supply and demand. They still want to do whatever they're doing, Wyckoff. Okay? Because that's the flavor of the month. If something comes in, I've always wanted to have time to myself to create some kind of abstract way of trading and show results on YouTube, and everybody would swarm to that only because of my results. And they would waste time trying to chase something that would have absolutely no bearing on why the market did what it did. I could dress it all up and make it look like it did that, just like Wyckoff and everything else retail. This is why it did that. But look at the symmetry of how the markets play out with what I teach you. Why it does what it does, when it does it, and why it's happening. Why is it doing it? I'm providing all of those things for you. So when I do lower time frame trading, I'm thinking how I could be ahead of the majority of high frequency trading algorithms. So I'm trying to get in before they would. I already know the bias. I already know the liquidity that's going to be drawn to. I know what I'm looking for relative to time. And how do I get in ahead of them? Well, I have to know how they get in, right? I taught you that today. So when you hear about high frequency trading or high frequency trading algorithms or quants that go in and do, high level entry frequencies, and you can do this on 1 minute charts too. I'm just showing you on a 5 minute chart. But you can go in with 30-second intervals. You can go in 15-second intervals. Okay. I saw one algorithm that was operating on 5-second intervals. And it's the same thing all the time. So whoever started this high frequency model of entering on breaks above highs, short-term highs, because it's showing that the momentum is in favor on upside. So the algorithm has a very simple entry filter. What does it need to know and what does it need to see to be a buyer? Well, you need to see a high broken. And you leave that algorithm running on a day that you're bullish. And every little short-term high, once it breaks it, you're in. And it does it all day long. And if you shorten it down to a lower time frame, like a 5-second interval, like you can get in there and have dozens of entries, rat-tat-tat-tat-tat-tat, and it just keeps firing in there. Sometimes brokers, and this has happened to me back in the 90s, they would throttle me. And when I say throttle, in other words, it would bog down and I would miss my entries. And when everything went to electronic trading in the early stages of that, sometimes my algorithm wouldn't be allowed to get in all the orders it was trying to put in because it would be throttled. The broker would just requote, and that's how they throttle you. Now, you can get mad about that and say, oh, you SOB, or say this about that. But sometimes it's not necessarily a nefarious reason why it's happening, because maybe your algorithm is just Tommy gunning their server too fast for it to process. And that was, in my mind, what was happening back in the early days of electronic trading. I have since learned not to try to do too much of that, because when you do it and you're right a lot, they ask you to leave. They don't want to be a part of that. Okay, so just know that in time, as you guys learn more about this, and the more math inclined individuals here that do have programming capabilities and able to build models that are electronic and automated, just know that when you start framing these things, that these types of events will eventually happen to you too. So that's why I teach, even in this mentorship. I know the new students probably haven't got to this part yet, but I talk about throwing losing trades once in a while and doing it on purpose. And I'm talking like doing things that are just nonsensical Go in, put in a trade, and in like a minute or two, close it. Even if it's moving in your favor, okay, just close it. Or if you know it's going to go up, go in and short it, put a ridiculous stop loss in that's too tight, let it come down and hit you. You want to throw as many smoke screens up as you possibly can, because when you win, you want it to look like it was a fluke, and they'll let you stay in because they're going to want you to be able to stay in long enough to give it back with interest. Okay, you're going to want to have more than one brokerage account over time, so that way when you start having tomfoolery in one broker, and they're going to do this, especially when you really push the limits of what you're learning here, you're going to have these types of things. You're going to have requotes. The fill won't happen, and the whole time the market takes off. So as you build more equity and you have more money, you want to open up other accounts in other brokerage firms. And you also want to create LLCs, okay? You want to create S-Corps if you're in the United States, and you can also talk to a tax professional. They'll help you with this. I'm only giving you basic guidelines. I'm not a tax person. I'm not legally in a position to tell you what to do with your money or how to frame a corporation. I'm suggesting that you do these things and look into it, so that way you can take advantage of all the perks and premiums that go along with it. But as you make more money, you want to create LLCs, and that way that's your identity when you open up the account. Now, obviously, it's a flow through. It goes through you and your social security number, but it, on the surface level, and you're spreading out all of your activity, it's just a better way for you. If you know they're running the number on you with one account and they're requoting and they won't let you fill in, you just go right to another account and put the orders in there, and they can worry about doing whatever they want to do with one account while you're over here doing it with another. You're still trying to do the same thing. In other words, I'm not trying to say you're buying in one account and selling in another. That's not what I'm saying. What I'm saying is, say you're trying to buy this market here, okay, and you tried to buy it here and you're making money, and you try to buy in more here, and you got in, and then you try to get in here, and now they're requoting you. The broker's now playing funny money games with you. It's legal. They can do it. But the point is if you start seeing that occur on your next entry, don't use that same account. Go into another account that you have either with that broker under an LLC or another LLC, or go in with an individual account from another broker altogether. So that way you're able to capitalize on all these positions. It's also good to have multiple accounts, because if you get caught with a broker that goes down, you can hedge in a position that you're in with one broker that you can't get out of. Like, for instance, consider what recently happened with Robinhood. I would never open up an account with a broker like Robinhood, but the point is, those individuals that were in that brokerage firm, if they had another account, they could have hedged while they couldn't get out of their other trades. They could have hedged in another account. And that's really only the way you can hedge in the United States, because we're not allowed to do that in the same account. But I can hedge with multiple accounts. If I'm in a real big position and I'm building up a large position, and I know there's the likelihood of I'm going to have some retracement for a day or two, I can trade in that position negative to my original position that's larger in another account. I'm hedging. It's not in the same account, but I'm hedging that position. So these are all things that you want to be thinking about as you're developing and as you build more equity up. And when you're using models that build affluence, you want to use your affluence and your wealth effectively. And that means not putting all your eggs in one basket. And if you give your ability to make money in the markets to one brokerage firm, you're really asking for failure, okay? Because there's going to be instances where you can't get in the move, or you can't get out of the trade. And that's a very frustrating thing. I've had that happen to me more than once. So I've learned to have multiple accounts. That way, if you have an outage with your brokerage that you have a trade in, you can go in right away and hedge it with another brokerage firm. Yes, that individual account may suffer, but you can pick up the difference or some of that with another account, trading it appropriately by hedging. So I kind of threw a lot at you with this one, but I got a lot of questions over the last couple weeks, and I'm just now digging into them, obviously. But this whole notion of high frequency trading, and am I going to teach it? I'm teaching it, but you still have to know the things I've been teaching you all along anyway. All it is being shown on a lower time frame using the bias, and I'm just teaching you the elements of why I trade and enter way I do, which is not Wyckoff, and it's not what the high frequency trading algorithms do in the industry. I'm getting in before they do, because their idea is they want to be the first order that fills when this high is broken here on that candle. They're all fighting to get in there to be the first entry there, because time on their side is the greatest advantage. Well, okay. Well, I agree. If that's the game you're going to play, yes, you have to be the leader, okay? Because you may not get that fill because it's going to run too fast, and then you'll end up catching something up here on slippage. I don't want to play that game. I'm going to be in there before them, and while they're waiting for this high to be broken here, I'm buying it down here where it's really, really cheap. I'm getting in where it's easy. It's giving me plenty of time to get that price. Time and price inside the bias. And before all the smart guys that everybody gets the credit for, the quants, the high frequency trading algorithms, the institutional traders. I'm in there before all of them boys. And all those guys are Johnny come latelys. Okay? They're all playing catch up ball. I'm in there way before them. And that's why I'm telling you the things that I teach you, they don't know. They all use these little breakouts with momentum. They understand that this is a bullish day. I'm not saying that they don't know that. But their whole methodology about getting in is buy on strength, or sell on weakness when it's bearish. I need to be buying at a discount even when it's bullish at logical levels. There's an inefficiency here, and this is an order block with a change in the state of delivery because of the crossover into New York Open. That's why you expect this retracement. That's why you expect stop running, because all this in here, anyone that's long from London, they're going to be ultra aggressive at having their stop losses below any short-term swing low. And look what it does. Whoop, right below there and there into the order block. After 7 o'clock, that's your Judas swing. Then it rallies. Then you go into redelivered rebalance. That starts with the framework here on a 15-minute time frame. If you go back and look at what I showed you on Friday's daily log entry, you'll see that redelivered rebalance, the ranges. We trade down into here for another buy, and then this is your last entry point using how I teach it, and the high frequency trading algorithms would be entering on this candle as it breaks above this high, and they'd be long there and trying to reach for whatever the daily range objective would be for them. So that's the skinny, if you will, or the inside track to high frequency trading and how I beat these quants that go in and try to buy, on high frequency entry points. But they're buying strength, they're buying short-term breaks above highs, and that's the only strategy they're using. And they're doing it on every time frame. They're doing it on 3-minute charts, they're doing it on 1-minute charts, they're doing it on 30-second charts, 15-second charts, 5-second charts. Okay? It's all the same strategy, and they're all fighting to get in to be the first one when it breaks these short-term highs. And there's a better game in town, and it's mine. And it's always buying it on the inefficiency, and before they're all rushing to get in here, I'm already looking down here. I'm getting the better fill. I'm getting in ahead of all of them. I don't need to rush, and if it never trades down to my entry point, I don't care, because I know there's going to be another one later on. They're just like buses, folks. Just sit back and relax. There'll be another one. And here you go. Now, there's other trades in here. And if I was honest with you, looking at this low right here, up to this high right here, Enigma has 32 entry points, all in this swing here. Now, I'm saying that because that is ridiculous compared to what you're learning in mentorship. And it's never going to be taught on YouTube, and it's never going to be taught on Telegram, despite some of you saying, I'm teaching more about Enigma, when I said I never would talk about Enigma. But I'm answering direct questions from people in Telegram. No, I answered very generic questions that aren't going to do anything to help them figure out Enigma. 32 trades. Okay, there's 32 trades in here. And it has nothing to do with fair value gaps. It has nothing to do with candles. So I'm only saying that so that way some of you in here that are getting all bent out of shape because you think I'm doing something more over in Telegram than I'm doing in here, you need to settle down, okay? I know where my obligations are, and I know how disrespectful that would be. And plus, it's mine. I'm not teaching it to any of you. I'm not teaching it to Telegram. I'm not teaching it to YouTube. I'm not teaching it to any of you in here. That's mine. That part is mine. That's for my family. But there's a strong contrast, isn't it? There's 32 entry points in this run from here to here. And that's how I can run up small accounts and blow it up and just keep building and parlaying it bigger and bigger and bigger. But if you want a layman's approach to high frequency trading, you just apply what I've been teaching you. On a lower time frame basis, here's an entry point at a discount. This is the target or terminus. This is where I told you on Wednesday the market would likely draw up to. So from here to there, where are the buying opportunities? Well, here they are. These are the most high probability entry points because it's relative to time. London, New York, London close caps the daily range for probability. It does not mean that that's going to be the end of the daily range. It's not going to go any higher. No, I'm not stating that. I'm saying the probabilities are capped during 10 o'clock to noon. And then everything after that is just usually a run up and continuation of what's already been given as an opportunity. In other words, what I'm saying is, in layman's terms, is between 10 o'clock and 11 o'clock, that's usually your last entry point. That's why I taught, even on YouTube, that you can take a trade with optimal trade entry between 8:30 in the morning New York time to 11 o'clock New York time. That 11 o'clock window will protect those free level students. If they don't take any more trades after 11 o'clock, they won't get hurt. That's why I taught that way, folks. That's why I didn't teach 7 to 10 the New York Open Kill Zone. Even though they've been taught that in free lessons in the YouTube channel, I taught them to use 8:30 to 11 because it forces them to stop taking entries at 11 o'clock. Because anything after that will probably hurt them. So, again, I'm trying to not only educate you this time, but also correct those of you in this mentorship that are getting a little unruly, thinking that I'm doing something that I should not be doing, and I'm giving, the meat, and the dessert to those undeserving that did not join mentorship, when that's not true at all. Hopefully I got your gears turning, if you will. But there also are going to be days where you have these real big strong runs, and 10 pip increments won't be factored at all. You'll have a big run up and it'll cross 20, 30, 40 pips, in a series of 1 or 2 candles. You have these big runs. That's something entirely different. And we'll cross that bridge when it's time to cross that bridge with your teachings. But everything I've taught you in the mentorship is seen here. Time, power 3, entry strategies, accumulation and distribution, real accumulation distribution, not Wyckoff accumulation distribution, not Larry Williams accumulation distribution, but real accumulation and distribution. Accumulate long, accumulate more longs, 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 and distribute those longs where there's willing buyers at a high price. Now, also take a closer look. Right in here, 10 o'clock, that's that New York Open Kill Zone. That's your redelivered rebalance. That's why you have this retracement. This is the beginning of the New York Open Kill Zone at 7 o'clock. That's why you have that deep retracement. 138 big figure. If we trade up through the 138 big figure and it's still bullish, how many pips can it go? 10, 20, 30, and as much as what? 40 pips. Almost got there on this chart, but you saw right before I got to this point, I did a quick slide and showed you that we did in fact trade up to 130, 40, and a little bit above that. So there's your 40 pips protocol once it trades through a big figure. That's algorithmic, folks. That's a signature that tells you that these things run with a macro. They do similar things most of the time, not all the time. Why? Because sometimes there's manual intervention. Sometimes a man or woman go in and they change things. And then you'll see these real big drastic prices of pricing lower or higher. That is manual intervention. That is not a vacuum of buyers or a vacuum of sellers and there was no buyers or no sellers and it just crashed down there. No, it is never ever happening. That's why you hear these things about, oh, this is a fat finger, or they tried to put this kid over there in the UK, he was the reason for the flash crash in the S&P. Man, that is crap. That's bogus. That's not what's going on. Anybody that sits down and studies the logic that I'm sharing here will see it for what it really is. And it does not matter if you choke on it, you don't like it, you don't agree with it. It doesn't change the facts. It doesn't remove the stain of truth that it has, because you can't wash it out. You can't rub it off with Ajax and you can't get it out with bleach. It's the truth. Whether you like it or not, learn to love it, operate in it, because this is what makes you rich. Until I talk to you next time, be safe.